Hello, everyone. Welcome to the third episode of Talks with Daulat. My name is Akshita Maheshwari, and I am the growth and content lead here at Daulat. Today, we have with us Varun Fatehpuria, the founder of Daulat. Daulat is a tech enabled, all in one solution for Indians to invest better and reach their financial goals. Before Daulat, Varun worked with some of the biggest investment institutions in the world, like Bloomberg and Blackstone. He also graduated with distinction in finance and information system from Hong Kong University of Science and Technology. He is also an NSIM certified investment advisor. We are glad to have you here with us.
Thank you for having me, Akshita, once again.
Yeah. So today we are going to discuss about retirement planning in the third episode of Talks with Daulat. My first question to you, Varun, is when is the right age to start retirement planning?
Again, I think, Akshita, so if I want to give you a point blank answer, the right age is today. I think if you're in your early 20s, just getting started with your career, I think thinking about retirement, even though it may seem like a long way to go, is a good place to start. Again, because traditionally, I think Indians have not been focusing so much on retirement. It seems like something which is a long way to go. And they seem this is something that they can really push off until up to a later point till when they actually have to do it. So if you're in your early 20s, just getting started with your career, I think the earlier you start, the better it is for you.
All right. So now that we know the importance of retirement planning, how exactly does one go about, beginning with it and doing the entire plannings?
So traditionally, if you have seen, right, I think the concept of retirement planning in and by itself is something which is a bit of a new and a novel concept for a lot of Indians today. I'm just trying to give you some background as to, why do we think retirement planning as a concept is suddenly coming to the forefront at this point in time. So I think traditionally, if you would have seen, retirement is something which most Indians did not actually think of up until a later point in time. It is only now that people are realizing, I think over the past 2 to 3 years, that retirement is something that they really need to think about early on in their careers. And there are really, I would say, four reasons as to why retirement planning as a concept is relevant today. Number one is the concept of joint family is slowly and gradually, I would say, reducing with each passing day. So I think as people and families are becoming more independent, it is on for them to basically have a sufficient retirement corpus, which can basically help them lead through the retirement years in an easier manner. I think previously, I think there was a lot of dependence on one's children and the family members to help them get through the retirement years. But I think slowly we are seeing that concept reducing, at least in the urban cities. So that's number one. I think the concept of joint family is slowly going away. Number two, the government sponsored retirement programs, again, typically is limited to, I would say, the employees of government institutions. And since a large majority of the Indian population is either unorganized, working in informal sector, working in the private sector, they do not really have that cushion of, I would say, thinking about retirement very early on. So they sort of tend to go ahead with their day-to-day life in the normal manner. So that's number two. The government-sponsored retirement programs is not really strong. So people are definitely looking for avenues outside of that to start thinking about retirement. Number three is, I would say, the cost of living definitely is increasing with each passing year. I think this is being true today. This is going to be true for the next 25 years. This is been true for the last 25 years as well. I think inflation again is something that is not a new concept, right? So the as the cost of living increases with each passing year, so the corpus itself for retirement also needs to grow in tandem. Just having a saving mindset around retirement planning or thinking this is something that I will do at a later point in time probably creates a lot more pressure. And we are going to talk about, with an example, how starting early gives you a major, I would say, breakthrough in terms of starting small, but letting that money compound over a longer period of time. And fourthly, again, is people are starting to think about it at this point in time. more importantly because what they had experienced over the last 2 to 3 years with COVID happening. And that may not, I would say, specifically tie in with the concept of retirement, but I think people have started to think that if an emergency situation does so arise in the future, they need to be ready with some amount of money to help them guide through. And a lot of, I would say, elderly people were severely impacted by COVID, unfortunately. And I think that point in time, having, I would say, uh, a purpose that can basically help you tide over that situation also comes in really handy. So these are basically the four reasons as to why, people need to start thinking about retirement or are thinking about retirement at this point in time in India.
Yeah, I mean, that definitely clarifies why there is a need for retirement planning, and it bursts a lot of myths around retirement planning too. So let's take an example. Suppose there is an individual who's 30 years old and they want to retire by 60. So how does that person go about, calculating the amount that they will need during the time of their retirement?
Okay. So before I come to the example in terms of, and all the listeners who are joining us through a podcast, since they will not be able to see the video recording, I'll try my best to talk about it as much as possible. But before jumping into that, I think it's also important to understand and bucket retirement into really two distinct buckets and two distinct categories that will help you basically put a lot more perspective uh, in terms of trying to think about retirement itself, right? So one is basically what we call as an accumulation phase. So let's say you are in your early 20s, early 30s, getting started with your working career or have been working for a decent period of time. At this point in time is when you basically, start sowing the seeds for retirement. You start basically saving or investing for it for a period which is 25, 30 years down the line, which you call as an accumulation phase. At this point in time, you are basically just sowing the seeds, starting to invest money, and hoping that this amount will grow into a substantial amount sometime later down the future. So that is one phase where you're literally just putting money and not withdrawing anything out of it. Now, once you basically reach, I would say, your retirement, you are in your 60s, you are done with your working career. Now you're thinking about you have this corpus with you, which you had saved up over the past 25, 30 years. How do you basically start drawing income out of that that can basically support you for the next 25, 30 years of your life? So, which we call as the distribution phase. Now, strategies for both of these phases look really, really different, right? I think there is no one size fit all, but at least trying to think of it from a more systematic manner will again make it a lot easier for you to plan for your retirement. So when you are in your accumulation phase, I think it's really important that you basically, have a higher allocation towards assets like equities, which have the most potential for giving long-term wealth creation rather than just saving money, putting into a bank account, putting into an FD. Even those, I would say, are guaranteed products and will definitely help you sort of like, protect your principal amount. But it is important to understand that will not help you create a corpus which will be enough to meet the needs of your retirement. So it is really important that when you're thinking from a longer term perspective, always look at instruments, always look at asset classes which have the highest potential to generate wealth. So that is for the accumulation phase. And then for the distribution phase itself, where now since that you have stopped working, you're not really putting a lot of money into the corpus, you need to take a bit of a more cautious stance. You need to take a bit more of a defensive stance, where you at least want to be sure that the money that you have saved up over the last 25, 30 years, right? Hard earned money. I mean, you have put in a lot of your time investing and saving that money. You need to make sure that money is at least protected. You cannot go and maybe invest into instruments which are highly volatile and which can drop in value over a period of time. So at that point in time, again, you take a more cautious approach. You invest into more safer products like, again, FDs and recurring deposits and government sponsored programs, which can give you at least an assured rate of return on that front. So that is basically, I would say, how you should actually think about retirement planning and really put it into two distinct products, right? Now, coming into the example where we need to start thinking about, okay, I know that I need to start saving for retirement. I'm in my 30s at this point in time. I'll probably retire when I get to 60. So now the question is, how much of money will I be requiring once I get to that age? So let me basically show this with a very simple calculator where you need to just input a few variables and where you will be able to see the amount of money that you will be requiring at the time of retirement and how much you need to really start, I would say, saving and investing every month at this point in time. So let me just share my screen. So as you can see in the retirement calculator, right, there are 4 to 5 variables that we need to input. One is your current age. So let's take, for example, you are 30 years old and you are wanting to retire when you get to 60. So I'll put in 60 over here. And let's say you are planning, I mean, again, life expectancy is something that obviously no one can really plan for, but let's say on an average, you will live for another 30 years. So I'll take as a good rule of thumb the expectancy to be 30. And then the amount required is really important because what we are really doing is we are seeing what your current monthly expenses are. Now, obviously, there will be some expenses which you will probably not incur when you retire, but at the same point in time, you will probably have more of the expenses towards something which you're not incurring at this point in time. So, for example, expenses for healthcare. I think today, if you're in your 30s, you are healthy, you're probably not spending so much of your money going to doctors on medicines and all of those things. But probably, let's say, just as a rule of thumb, you will be spending for that once you get to your retirement. So we are just going to input an amount what your monthly expenses are at this point in time. So let's say your current monthly expenses are 50,000 rupees a month. All right. And then we have, sorry, let me say that's 50,000. Life expectancy is 90. And then the expected rate of return is basically telling you that if you start saving and investing money today, what is an approximate rate of return that you can possibly generate from where you are investing. Now, also, this is dependent on where you are investing, right? Let's say if you're investing into more safer assets like fixed deposits and banks and all of those things, that will probably not give you more than 7 to 8% return. But if you're investing into more high wealth creation, I would say products like equity, then you can reasonably be assured that you can at least get 10 to 12% return over there. So I'll just input 12% over there. That's pretty, I would say, a standard amount which a lot of people actually tend to, assume for an equity investment. And then the inflation rate is basically what the standard inflation rate would be, or what an historic average inflation rate has been. So just for the sake of argument, we'll assume it is 5%. And then the current savings is, let's say you have not really saved anything for your retirement. So I'll just input this as 1. So as you can see in the result section now, the total goal which is required, or let's say the retirement amount that you need once you get to your retirement is approximately 7.8 crores, right? This is basically based on a 30-year period. You are in your 30s, you will retire when you get to 60, and what your current monthly expenses are, which are basically adjusted for inflation. And that gives you a goal retirement, I would say, number of approximately 7.8 crores. Now, this is basically what you need to have by the time you retire to be able to support you for the next 30 years of your life. And then if you can see a simple SIP amount, so you really just need to start saving or investing 22,000 rupees a month. That's it. If you just invest this money for the next 30 years at an assumed rate of return of approximately 12%, not a big amount for working, for someone who's working, you can get to your retirement very easily. But let's say if I just want to see, and let's say if you want to start investing when you're 40, you can see in 10 years amount of time, the SIP that you need to do every month literally increases to the double of that. And obviously, I think the retirement expenses will also increase in tandem. So that probably will become, I would say, 1 lakh rupee. right? So you can see how basically you can play around with this calculator and how that literally affects how much you need to save uh, and have by the time you retire, and also the regular contributions that you need to make to the retirement amount. So that is basically simply the concept of retirement and how much you really need to think about from a planning perspective.
Right, got it. I feel like the division of the entire retirement planning phase into two parts, the accumulation and the distribution phase, really clarifies a lot of things. And also, the calculator makes it really easy to understand how much amount you need when you retire, which otherwise is something that seems very daunting to people. So this really makes things easy. So my next question to you is, what are the various investment options that are available to people like during the retirement planning stage?
So today, if you see in India, like again, to keep it simple for the sake of this uh, interview, there really, I would say, 3 to 4 options that any individual today can invest in, can save towards for the retirement. Number one, and I think perhaps the most popular, is Public Provident Fund or PPF, where typically a lot of people, I would say, to max out on their 80C income tax deduction every year, invest 1.5 lakh rupees. And that is locked in for a period of 15 years. Which you can further renew at a blocks of 5 year each. So about, if you're looking at about from a 25-year perspective, investing every year 1.5 lakh rupees, which you can get pretty much a tax-free return of approximately 7%. Right. So that is one of the options that is available, which a lot of people actually tend to. The other but which is a more, I would say, a newer concept, and again, a government sponsored program, is called the NPS, or the National Pension System, where the concept is that you cannot really withdraw your money until you reach 60. And then, even once you reach your retirement age, you can only withdraw up to about 60% of the corpus once you retire. The balance 40% is invested into an annuity program, which will give you monthly payouts. So, the goal here basically was for the government that the individual does not really, I would say, withdraw all the money that they see, and have a sufficient amount of money to help them lead through their retirement years. The third option is basically what is called an employee provident fund, where you make monthly contributions to a pool of money, and your employer also makes monthly contributions to it. And then you basically get again say a 7 to 8% return on that, which you cannot really touch for I would say 10 to 15 years, until unless there is I would say needs like a home down payment or a wedding expense or an education expense, right? So that's the employee provident fund. And then finally, we have again, which is more of a market linked product, and again, which is sort of gaining traction at this point in time, are the mutual funds. Mutual funds, again, from all the available options that we just spoke about, tend to be the most flexible. You do not really have a lot of lock in period over here. You get market linked returns, but at the same time, have the flexibility of investing as much as you want, as little as you want, and withdrawing whenever the need may arise. So these are the 4 available options that any individual have in the country for the most part to build up for the retirement.
Right, got it. And if you could talk a little about some of the income generation options that people have after they've retired.
So what I just talked about was basically the accumulation phase of, I would say, a retirement, where you're inputting and money into your retirement corpus, right? Now, when you talk about the distribution phase, at which I talked about earlier, your investment strategies tend to look really different. At that point in time, basically, you need to look for options which can provide you a regular payout, right? So one of again, we have 3 to 4 options which are available today in the country. One of the options is something called as a senior citizen savings schemes, where a senior citizen aged 60 or above can invest up till 30 lakh rupees, which was just revised in this recent budget, and then can get a quarterly interest payout of approximately, I would say, 8% per annum, right? So you're looking at approximately 2% uh, that you can generate every quarter out of the 30 lakh corpus. So that is one option. The other option is basically interest income from the fixed deposits, which again tend to be a very, very popular option, where you again input a certain amount of money, put it into an FD, and then you can get interest payouts on that. The only drawback for these 2 options tend to be that the interest income that you generate is taxed basically at whatever income tax slab that you are at. So from a tax perspective, it tends to be, a bit tax inefficient. The third option is the NPS, where you can basically generate annuity income from your retirement corpus. And since that it is mandated, the 40% of your corpus needs to be invested into an annuity program. That is something that you can look forward to also from an income generation perspective. And the fourth option is, if you're investing in mutual funds, is a process called systematic withdrawal plan. So think of it as an SIP in reverse, just how every month you put or start investing into mutual funds through an SIP. In the same manner, if you want to start withdrawing money, you can do that by a process called as a systematic withdrawal plan. From both a tax perspective and a flexibility perspective, again, this tends to be the most, I would say, flexible option and popular amongst a lot of people today.
All right, understood. Finally, Varun, if you could tell me a little about, what are the common mistakes that people make when they're planning for retirement and how they can avoid it?
So again, a couple of mistakes that I've seen a lot of people make today, right? I think one is definitely not starting early enough. Again, people, I would say, tend to be lazy. People do not really want to think about retirement at this point in time. And they think it's still 25, 30 years down the line. Why do I really need to start thinking about something which is so far off in the future, right? No one really knows what happens. And I will see when the time comes. I think that is not really a very good approach to take. I think just to be fiscally prudent and responsible. I think the earlier you start, the smaller amount of money you actually need to invest for a retirement pool, and really you can really see the power of compounding at work when you start early. So don't think of it as something that you will start once you start approaching your retirement, because again the amount of pressure that you will have financially at that point in time will be significantly higher than what you have at this point in time. And the second mistake that I also see a lot of people uh, making is that, okay, now that they're convinced that they need to start investing for retirement, they tend to take a very cautious approach, right? Because this is my retirement pool, I don't want anything to happen, so I'll just invest in the most safe products. Again, I think that is not a very good approach, because what you're essentially doing is, if you're investing your money into just a bank account or a fixed deposit, what you'll see is, yes, you would have saved a certain amount of money, but that probably wouldn't have been enough to actually meet the cost of living at point in time when you retire. So obviously, always look for instruments which can have the highest potential to generate long-term wealth. And I'm talking about equities, which can have the maximum potential, right? In the short term, it will probably be a lot more volatile. You'll think of it as a very risky instrument, but over a 25 to 30-year period, I think it has the maximum benefits that it can provide you from a retirement point of view. So I think these are the two most common mistakes that I see a lot of people around me making when they think about retirement.
All right, understood. My last question to you is, if you could talk a little about, the importance of asset allocation during retirement, and how does an individual ensure that their allocation, their portfolio is appropriately diversified?
So again, now you see why the concept where I talked about the accumulation phase and the distribution phase is really coming into the picture, right? It's really allowing you to think about retirement into two distinct phases. So as I talked about just earlier, in your accumulation phase, obviously you tend to be a lot more aggressive. You're investing for a 25, 30-year period. At that point in time, you'll probably want to have a majority of your, I would say, portfolio from an asset allocation point of view invested into equity. So about 80 to 90% of your assets can actually be invested into equities, because that can give you the higher potential to generate wealth, and a smaller amount of money, I would say, to be honest, to invest every month to get to that goal. And then from a distribution phase perspective, where now, since you have accumulated a certain amount of money, obviously you want that money to be protected. So at that point in time, investing into equities and then drawing income out of it is probably not a very good option. But at the same time, because you want to withdraw income out of it for the next 25 to 30 years, right, from age of 60 to about 85 to 90. So that is still a very, I would say, substantial amount of time. At that point in time, also having 100% allocation to safer instruments like debt is not a very good option. But yes, you need to have a majority allocation, approximately 70 to 75%, which provides some sort of a cushion to your portfolio, and the balance 20 to 25% can be invested into low cost index funds, equity funds, that again can have the potential to generate long term wealth. So it is really trying to strike a balance between debt and equity, both at the accumulation phase and also at the distribution phase.
All right, understood. Well, thank you so much, Varun. I hope that our audience found this session insightful. I will see you again next week.
Yeah, thank you, Akshita.